Welcome to part 5 of our 10-part series on calculating the economic and environmental cost of Bitcoin. I'm Hass, and as promised, this will be the last of 3 episodes on economics, perfect competition, and managerial economics. The Porter's 5 or 6 forces framework is a mainstay of the typical MBA curriculum. Here are the forces within the Bitcoin mining market. Mapped out, prospects look quite daunting for an industry competitor. They cannot easily protect themselves from new miners or substitute products, such as other digital currencies. They are price takers with little power over their buyers, and unless they are an innovation leader in the fields of hardware manufacture and research and development, data center ownership, and/or electricity provision, they have little control over their suppliers too. As mentioned previously, collaborators, that is, other ecosystem participants, currently have equal potential for benefit and detriment, whilst the market is still susceptible to shocks. Competition is stiff within the mining industry, and a prompt extinction awaits if you are not a cost or innovation leader. This is expected. Economic profit tends to zero in long-term equilibrium in a perfectly competitive landscape, and the marginal cost of producing and the market price oscillate around an equilibrium point, with evolution and improvement the only way to stay in business. In such competitive markets, there is also a natural tendency for the market to be dominated by 3 or 4 players. The Pareto principle, also known as the 80-20 rule, states that 20% of the market participants control 80% of the market. In November 2015, the 5 largest pools provided 79% of the mining power. In June 2018, the largest 5 provided 70% of the hash rate, with 78% of the power coming from the top 6. That said, these pools are not monolithic entities. In a perfectly competitive market, a firm's decisions are predictable. All firms need to decide to start up, how to run their business as cost effectively as possible, and whether to stay in business or not. In the Bitcoin world, the decision-making process relies on market price of Bitcoin, operating expenditure, which I'll be referring to from now on as OPEX, and the network hash rate. That is, how much competing mining power exists on the network. It also indirectly relies on the continued faith and investment of miners in the value of their commodity. That is, continued research and development, capital expenditure, and strategic partnerships with collaborators. Now, let's go through a list of price, hash rate scenarios and what it means for miners. Let's lock in an increasing price trend. That is, the price is moving above the equilibrium line. If hash rate increases, there is short-term profit and new miners enter to capture some of it. If hash rate is decreasing, incumbent miners who haven't switched off their mining rigs are getting richer. Now let's lock in a stable price trend. Not like that has ever happened before in Bitcoin's history though. If hash rate increases, then innovation and cost leaders will emerge from the field and profits will decrease due to stiffer competition. If hash rate is decreasing, there is short-term profit to be made by incumbent miners, re-entrants, or new entrants. The famous downward trend. It never lets the hodlers down. Here, if hash rate increases, inefficient miners will stop mining. Some miners may start to buy coins instead of mine them, and/or engage in some financial wizardry with futures, options, and all of the other financial instruments available to those with a will to get their hands on them. Since the future appears full of opportunities for the digital macroeconomy, one should expect digital microeconomies to become more perfectly competitive as time passes. Should long amounts of time, say 50 years pass, when all bitcoins have effectively been mined and the ecosystem is still healthy and has entered the redistribution stage, microeconomies such as the Bitcoin mining market will start to resemble the textbook examples of perfect competition. In time, miners will vertically integrate backwards by acquiring data centers, chip fabricators, research and development teams, and renewable power plants, and integrate forwards by acquiring exchanges, brokers, and other places to sell what they have mined. They can horizontally integrate by acquiring entities that enrich the value of their commodity, such as wallet hardware and other product manufacturers, financial services companies, and media outlets. 80% of the market will be controlled by 20% of the largest and most integrated market participants, with the other 80% providing the niche and evolving needs of the market. As time goes on, the makeup of the microeconomy will evolve until its extinction and replacement. Now that you have a very thorough understanding of the market, and what is going through a miner's mind, the focus of the video series will shift to the cost of mining Bitcoin. Next week, we finally get into the meat of the series, where we will start looking at the drivers and assumptions used to model economic costs. We will look at environmental cost drivers in the episode after that. As always, thanks for watching. Click like and subscribe to our channel. Leave a comment below. Check out the links in the description for more info and references, and catch us on Twitter and LinkedIn for more. Until next time.